This chart tracks the recent climb of the 30-year fixed mortgage rate, which just hit a one-month high of 6.56%. This morning provided a brief sigh of relief. Following overnight military tensions, a U.S. general stated that recent attacks from Iran fell below the threshold for full-scale war. That de-escalation quickly pulled global oil prices down. Because oil prices and bond yields share a mechanical correlation, bond yields followed right along. The result was a modest recovery, where bond yields dropped by exactly 2 basis points. However, 2 major economic reports are scheduled for 10 a.m. Eastern Time: job openings and ISM services. This morning's minor recovery is fragile. Whether it survives the day depends on what happens when that 10 a.m. data collides with the current psychology of investors. Economic reports are historically the strongest drivers of volatility in the bond market. This flowchart demonstrates the historical baseline. A strong economy input, like a surge in job openings, pushes the higher rates and yields upward. A weak economy input pulls those same rates downward in equal measure. In a typical market, investors treat these reports like a balanced scale. Economic news translates into a proportional move in borrowing rates. Today's market environment has broken that balanced scale. Investors are heavily positioned for economic weakness as the expected result of sustained high fuel prices. This baked-in pessimism skews how the market processes incoming data. Here, an expectation baseline is set low. Economic weakness lands on this line with no impact, sending zero movement to mortgage rates. But unexpected economic strength shatters the baseline, transferring energy that causes an immediate rate spike. This is asymmetric risk, where potential for penalty far outweighs the reward. Consequently, mortgage rates are exposed to a lopsided volatility. Borrowers face high exposure to an upside surprise, with no significant safety net if data comes in weak. This mechanic dictates the immediate reality for anyone tracking or securing a mortgage rate today. Mortgage rates now track the gap between incoming numbers and pre-existing investor anxieties. Borrowers should not expect significant rate drops even if today's data is poor, as the market has already anticipated that weakness. The primary danger is unexpected economic resilience, which currently stands as the single biggest threat to borrowing costs. We are operating in a defensive, asymmetric market setup. Until this shift resolves, good news for the economy remains punishing news for the individual borrower.